Okay, let's get to the Q&A from Sunday's Market Outlook. I've been through some of these questions. Some are good, some are really small in its focus. Um, so questions that I myself would never ask, that I'd never ask myself, even though I may observe something, only because I just don't know that there would be much value in spending much time on it. But I will try to answer some of the smaller detail stuff if I know the answer. I looked into the large spike in agency debt issuance. I downloaded the spreadsheets for SIFMA, and the FHLB falls under the agency debt umbrella. The Federal Home Loan Bank. I think increased level of borrowing from the Federal Home Loan Bank that occurred in March, as they were seen as the lender of second last resort, might have caused that spike. Well, there we go. If you go back and look at each year since 2008, the year-to-date 2023 agency debt issuance is on average 110% of the full year's worth of agency debt issuance. That's huge. Let's see. What do you think will be the best way to start your applied series for someone who is 22 and doesn't have that much knowledge or experience? I already have started with your options course and always watch these market outlook videos. Should I start with the sector studies? Yeah, I think that would be a good place to start. Get a good idea of at least the ones that I have up. I have 5 of the 11 up now. The rest are coming in the fall. Yeah, I agree. That starts to give you a top-down view of the economy. Let's see. Okay, so these are some of the questions I find are, really particular and sort of, I think, okay, other than, I think, having an interesting intellectual conversation on them, I don't know that the answers to these would do much. Can you comment on how much of a role you think positioning plays in terms of market movements? According to CFTC data, hedge funds have their biggest short position on the stock market since 2011. Generally, when this is the case, the market is in the process of bottoming. Well, that wasn't the case in 2011. CTAs also seem to be a driving force of the market moving higher as of late, given how offside these systematic buyers are, resulting in money inflow into the market in up, flattened, down tape. So I don't know that that's true, or if that is just your supposition in saying that they are the driving force. I don't know that that's true. Also, it feels like pretty much all equity macro strategists are bearish on CNBC Bloomberg, yet the market continues to go up. Yeah, which is a head scratcher. I think it's going up on very light volume, which you can get outsized moves on that. It seems to have some reluctance to want to get above, 4150, 4200, but it has a reluctance to go down. I think the anticipation of the recession that everyone is expecting is going to be based on an exogenous event, because exogenous events always happen. And in the environment that we're in, it doesn't take much of an exogenous event to create a problem. It only takes one credit problem from a place that nobody expected, and that's it. It happens that fast. So I think that there is some hesitancy to buy at higher prices than where we are now, simply because, well, yeah, I think we'll have an opportunity to buy lower, but there's a lot of asset managers who are long only, who are in a position of saying, look, we've had a year to rebalance and we're as defensive as we can be right now. We're pretty much where we're going to be and where we're going to stay, because it has drawn out for some time. So I've said this before, for the market to go down, it's not enough to have the fear of bad news. The bad news actually has to show up. But for markets to go up, all you need is hope. The hope never actually has to show up. The hope just has to stay alive, and up we go. But fear is not enough to bring a market down. The bad news actually has to show up. So it's asymmetric in that sense. As far as positioning goes, I don't know. I don't know. There's positioning going on all the time. It's hard data to pull apart. I think the relative change week over week can give us some idea of the sentiment. I think positioning tells me about sentiment, but beyond that, I don't know that I would look at positioning and say, aha, I'm ready to make a big bet now. No. Given the year-to-date rally, how much do you think the market is already pricing in a better than feared earnings season? Probably already pricing it in, I'm sure. And I think that some of the market rally is the looking past part. We're looking past, I've heard this lots of times now, we're looking past 2023 to 2024. We're looking past the summer. We're looking past, the economic slope. We're looking past the rate hikes. Well, if we're going to look past stuff, why 2024? Like, why not February 2024? And if February, why not March? And if March, why not April? And if April, if we keep doing that, then why not 2025? Why not 2020? Why not 2030? Do we think the market will eventually get to 7,000? And if we all agree that, yeah, at some point, well, why don't we just look past everything and go there now? I don't like this, I'm looking past it. How do you know what the other side looks like? If we do have a recession, it tends to change the environment. How do you know that the economy or that the market will perform the same way in the next environment? How do you know the stocks that you own will even exist in the next environment? How do you know there won't be some firm death? How do you know how bad, how shallow, how long it's going to be? How do you know what credit is going to look like on the other side? What the cost of capital is going to look like? How can you look past something that is unknown? I don't get that, but it's a lot of hope that things are going to be better than what we think, and I'm looking past this. Well, I'm looking past this, I don't think is much of a reason. Comment on the importance of the composition of the S&P. Mega cap tech names seem to be the key drivers of the market moving higher. Small and mid cap stocks are basically revisiting their October lows. Are they? I don't know that that's true. How can the S&P 500 actually drop unless mega cap tech names drop? Drop under their own weight. Yeah, I think you might have a point that some companies are trading at such low multiples now that how much lower can they go? That you have these mega cap tech names that are trading still some 20, 30 times forward earnings. And I think 5 or 6 stocks now make up 20% of the S&P. That they would have to give up the ghost to some degree. But if you have a recession, then everybody's earnings are in question. Everybody's. So I don't know that I'm going to get a lot of value by breaking down the index into the 490 and the 10 and pricing out the 490 differently than the 10. I don't know that I would get much value out of doing that. How can you be bearish on some of the REITs, given where some private real estate assets are transacting? Well, when you say some private, which ones are you referring to? And I'm bearish on office and retail. So when you say some private real estate assets, which ones? What are you looking at? What examples do you have? I usually don't, when somebody says, I saw somewhere, I heard somewhere, I read somewhere. I mean, well, did you? Some private real estate assets are transacting. You're asking me to take your word for it, and since I have no evidence of anything transacting at any price, I can't take your word for it. Where some private real estate assets are transacting from which you are seeing going in cap rates at much lower levels. I am seeing from which you are seeing, well, see, I don't know if that's true or not, right? I mean, you're saying it, but I don't know that that's true. At much lower levels than the implied cap rates that these REITs are trading at. Can't you make the argument that private real estate market needs to correct, whereas REITs have overcorrected? Well, you can. You can make that argument, but in that question, you've asked me to accept a lot of things that I don't know that are true. So I don't know that I have an answer for that. How does your broker allow you to sell naked calls on various ETF stocks? I don't know. I just do. Need a margin account, I imagine. Maybe you're in a jurisdiction that doesn't allow it, but based on your questions, it doesn't seem like you'd have those questions from a different jurisdiction. So I don't know. I just do. It's quite common. I don't know that it's rare. On average, how many options positions do you manage at any one time? I don't know. That's a good question. Sometimes I'll have like 6 or 7 different options open on the same underlying. Different strikes, different months, depending on what I'm trying to get done and depending on where the movement happens to be and where I want to put my delta. If I just think option contracts or I think underlyings maybe about 15 to 20. Option contracts, they can run into the thousands, like 4,000 open contracts at any given time. I believe you mentioned you're changing, expanding your applied options course in the fall. Yep. Any interest in giving us a preview? Yep. You can go to the site and select it when you are, just pretend you're buying the applied options. You'll see a PDF that you can download that PDF, and it's, I think, 20 pages long, and it'll explain exactly what is coming in the fall. About CAD, a commentator on BNN was once telling that in Canada and some other countries like Northern Europe, large household debt and its importance to the overall economy, higher interest rates at these levels will weaken the currency because it weakens the outlook for the economy. If we make that argument, the Canadian, it starts to explain the movements in the Canadian, because it just seems counter to covered interest rate or even uncovered interest rate, where we're just talking about differentials between interest rates. I have a question on your theory of why VIX seems to be broken. If 0 day to expiration volume is taken away from 17-day plus, causing higher intraday vol and dampening longer term vol, why is it that VIX is only now broken, considering 0 day to expiration has been out almost a year? I don't know. I put it forward as a hypothesis that still needs to be tested. I said maybe it's this. It wasn't a conclusion, which then requires me to justify why it's only now broken. It's only just a hypothesis, and perhaps that it's been out a year and then volume has done this, whereas volume from the 17-day options have been doing this, and that it is only recently where we've seen volatility drop. Again, this is another hypothesis that would have to be tested. Where would one track how the 40-year mortgage is taking off being used by borrowers? I don't know. Google, I think, would be your best option there. From where would home builders take their indication of the types of homes the market needs or demands? Well, usually a home builder will have like a series of layouts, usually like 12 types of model homes. And it depends on the type of community that they're building. And where it is that they're building it. So some communities need to have an average, a price range. You can't put houses in some communities that, are $350,000 beside $1 million homes. You'll never sell the $1 million because nobody wants to live around the smaller houses, because if you're buying a certain type or a certain price of house, you are buying economic segregation. And you want to be with like-minded people and people that are in your, socioeconomic level. Most home builders build out communities, not one-off homes. And in those communities, they may have a range of prices, and that's it. So it depends on where the community is. Is it outside a major city, a secondary city, a smaller city? What's the medium income in the city? What's the carrying value in the city? If you price your house at $650 or higher, you're not going to sell anything in this particular city in that neighborhood. But if you're between $450 and $550, that's the right price. I mean, it's a lot of that, right? But once they decide on a community, usually you have an architect who'll design like 8 to 10 different types of layouts. You can't have 50 different layouts because you're never going to get volume, because you have too many houses that are one-offs. You have to have a certain amount of standardization when you build out like a neighborhood of 300 houses. So it's usually built to the neighborhood. And then the neighborhood will attract the buyers that economically segregate into that neighborhood. I guess that would be the best way to say it. You mentioned starting to look like we are in scenario 2. Does that mean your recession thesis has changed? Nope. No, it hasn't changed. It's just right now I think that we are sort of in that sideways channel. If we try to push the economy higher, inflation starts showing up again, higher rates go higher, you're more likely to break things. If the economy slows down, I don't think the Fed's going to cut rates at all. Something really has to fall apart for the Fed to cut rates. They've been very, very clear on that. Very clear. I don't think they're lying. So yeah, I think we're in stage 2. It doesn't change my recession thesis. You're saying that we are range bound until something breaks. Yes, which could potentially lead to a recession. I'm still in the recession camp for a lot of reasons that you've explored in your previous outlooks. Very hard pressed to come up with a substantial bull case. So there are 2 types of recessions, right, that are bad for markets. There's earnings recessions, and then there's the economic recession. An earnings recession will cause cuts. Whenever a company cuts costs, it's good for the company, but it's bad for everyone else because what it was spending money on was somebody else's income. So if I decide that, you know what, I spend 30 grand a month, I'm going to now spend 20 grand a month. Well, great, I have an extra $10,000 a month, but somebody else doesn't. Or a number of other people don't have $10,000 a month. So I've taken that demand out of the market because if I'm cutting costs, I'm not contributing to aggregate demand. I'm actually cutting costs. Well, that cost was somebody else's income. So that becomes that when you have this earnings recession that then starts the cost cutting and the efficiency gains and the layoffs, which we're seeing this week. Facebook announced more layoffs. Disney announced layoffs. Almost every company coming out saying we're cutting operational costs. Tesla reported after hours margins less than 20%. What did I say? I said it'll fall. Their operating margins 11.8. Stellantis, S-T-L-A. Almost curious that it has the same letters as Tesla. Stellantis, 13.8. Stellantis has better operating margins than Tesla, and Stellantis sells more EVs in Europe than Tesla. I don't know. Doesn't look like Tesla is such a leader, right? But anyways, what do they say? Oh, we have a whole bunch of operational cost cutting coming in. Well, that cost cutting is somebody else's income. So somewhere down the line, somebody's not going to get income and they're going to have to lay off and cut costs, which is also somebody else's income, and that's what starts it. So usually you'll get some kind of earnings recession first, which starts efficiency, which can, if the efficiency is widespread enough, or the search for efficiency and the operational cost cuts are widespread enough, could then lead to an increase in unemployment, which is a drop in demand, which then causes the next round of cost cuts because the aggregate demand drops, everybody's revenues drop, and they got to look for more efficiency gains. Q4 2022 was the first quarter of the earnings recession. If this quarter also comes in as negative growth, then you are in an earnings recession. That is usually the beginning of leading to an economic recession. So, yeah, you can still stay in the recession camp. If you opened 100 contracts at 104, I'm assuming you still have a fairly bearish thesis. Yeah, I don't mind being long TLT at all. So I'm good with that. I read the open markets report during 2022 from the Fed, and the following statement was included. Usage of the reverse repo facility expected to decline over time, which should slow the decline of reserves as balance sheet runoff continues. The process would occur as declining reserve levels increase competition for private money market funding and draw funds out of the reverse repo. So right now you have deposits and you have money market funds, and you have deposits doing this because they can get more money over here. Well, at some point, you're going to have to get aggressive over here and start raising deposit rates. At some point, you're going to have to stop the flow going into money market funds and even to try to compete to get it back. You're going to have to because banks need a source of funding, and deposits are a large source of funding. You can't just let all the deposits run away, because if they do, well, you're going to need some funding from something. You're going to need money from somewhere. So they're going to have to start competing with money market funds, and that's what it's saying here. Will increase competition for private money market funding. That's all that's saying. Just wanted to get your thoughts on buying, investing in properties that are close or around U.S. military bases. Okay, full stop there. I don't know. I have no idea. That seems very, very particular. I know nothing about U.S. military bases. I know nothing about the property around U.S. military bases or the maintenance. I know nothing about the income of the people on the base. I don't know anything about on-house basing versus off-house basing. I am nowhere near informed enough to make any kind of assessment on that at all. Would re-implementing Glass-Steagall and or increasing equity capital requirements remedy the banking crisis? Okay, we'll stop there. Let's imagine, my driveway is on a bit of a slope. If I put my truck in neutral, it rolls backwards. So let's say I put my truck in neutral and I get out of my truck and I run all the way to the back of my truck and I stand there and it runs me over. Do you think that we need better regulation on automobile makers such that the vehicle should not be able to shift into neutral when it's on a slope? We need regulation. Look, somebody got hurt. Well, you wouldn't say that. You'd say, well, the guy was an idiot. You don't need regulation for idiocy. The guy was an idiot. We live in in basically a free choice world, and sometimes you are free to choose to be an idiot. You suffer the consequences. When I did the video for SVB, I did conclude quite clearly that this was just a general lack of risk management. Should we run and regulate a whole industry because somebody didn't do their job? Should we run and regulate the whole auto industry because I ran behind my vehicle in neutral on an incline? I kind of look at it the same way. So I don't know that I would run to regulation in this case. This was a lack of management, a lack of risk management, and plain and simple. Let's see. I'm following the income strategy of aiming 0.1% of daily theta, selling options on 8 to 10 stocks. Income factories last month went good. But sometime in last month, SPY went up about 7%. Well, I had idle cash. I have access to portfolio margin in IB. What's your opinion of having 50% of the cash in the SPY or QQQ? Yeah. The 0.1 of your portfolio is very, very low. That assumes that you still have some assets that are performing. You still didn't underperform because IB pays you 4.3% on your cash, so you were making an income on your cash. But most definitely have some long positions. This is one strategy you can add to your portfolio. It is not the single strategy. It's just one source of income that you would do. And 0.1 is such a small amount that it doesn't cannibalize your entire portfolio just to get it done. But definitely have some long positions as well. Let's see, any scenario where we would not have a recession. Inflation comes all the way down very, very quickly. Companies hoard labor. They don't get rid of labor. And in time, companies adjust to the higher cost of capital and off they go. In a probably lower growth environment than what we've had for the last 10 years. But under that scenario, margins would get squeezed, which means stock prices are too high. So the proper question is not can we avoid an economic recession? The proper question is can we avoid both an earnings recession and an economic recession? Because you can avoid the economic recession at the cost of lower margins because companies hoard labor as the economy slows down and they don't release labor, which doesn't allow the economy to slow down, and inflation somehow magically still all goes away. But you'd have an earnings recession. And as investors, I don't know that we care too much about the economic recession as the earnings recession, because that's what causes lower multiples, is when you have earnings declining. I don't know that you can avoid both. Maybe you can squeak by with a soft landing close to the zero line, 0.5 growth, 1% growth, something really anemic and low. But I don't know that earnings would escape. you would need an acceleration of economic activity to increase earnings so that you avoid an earnings recession. Well, then you've got inflation coming right back again, because where are you going to get the labor to get that done? Which means higher rates, which means that would slow down the economy again. Unless the U.S. is willing to open up their borders and let in 2-3 million people over the next 6 months, then you would depress wages. You'd push wages down significantly, but you'd push up housing costs, and well, there goes inflation again, right? So at this point, I don't know that there's a way to avoid both an earnings and an economic recession. What's your framework for entry points on your favorite groups? I don't know that I have a framework for entry points as much as I just have a feeling from day to day, or I just look at them and I think, well, the market just doesn't feel like it today. With implied volatility as low as it is, I'm not that eager to sell puts, and I don't like buying at the levels that they're at right now because I know I'm going to get a better entry point. I know I am. So patience, I think, is my framework at this point. Did the reverse or cycle-to-date balance sheet run off with bank term lending? No, those are two different things. Bank term lending is you give me some securities you're holding as collateral, I'll lend you some money. Balance sheet runoff is I'm not going to reinvest in this treasury. I'm just going to let it run off, and now somebody else is available to invest in it. Do you know of any other reliable economists that provide weekly, bi-weekly market commentary like yourself? Either you're relying on Bloomberg or CNBC to get it done for you, in which case it's done for TV. It's all, economic analysis by soundbite. Not a lot of deep analysis. Some places do have interviews with market participants that go a lot deeper. Some do. There's one that I watch. Not so much because the two guys go really deep, but their guests go deeper. At least when they don't have the chart guys on, they seem to like the chart guys a lot, and I forget the name of it. Right on the tip of my tongue, but I forget the name of it. But I don't mind it every now and then. Sometimes they have some well-spoken people on, and I think it's interesting to watch. Beyond that, I don't know that I look for a lot of these types of channels. Princeton has a good series. Marcus Academy at Princeton is a good series. It used to be weekly, where they'd have different presentations on, like nice deeper presentations. A lot of good, interesting stuff there. And then it's just a matter of certain people that you like. Cliff Asness, Howard Marks, if you YouTube them, search them on YouTube, find their latest interviews or their latest things that they're talking about. You can follow them. They've got some good stuff, but I don't know. I search all the time. I don't really find a lot reliable that I'd listen to on a regular basis. Please explain why yield on agency and ABR is so high. Well, because the price is so low. What are the benefits to owning REITs? Well, mortgage REITs, income, really. Briefly explain why you specialize in them. Not anymore. I did. I'm out of all equity REITs altogether. To what extent do you think that the increase in property prices is not simply due to an imbalance of supply-demand due to housing regulation, planning policy, population growth, but is also heavily influenced by increasing wealth inequality? Increase in property prices due to wealth inequality. You got 68% home ownership. That would suggest that 68% of the population have money to buy homes. I don't know what's so shocking. Yeah, you don't need wealth inequality to create that. That's always been the case. You have a 60-40 split roughly, where 40% of your population probably will never be home buyers. They're renters. I mean, duh. Right? I don't know that wealth inequality I don't know that that would be driving anything really. If it were wealth inequality driving it, and you had a Pareto distribution, and a Pareto distribution is so common in so many different things that I don't know why we're shocked to find it in actual performance of individuals, because it is a distribution in performance of individuals. And if money rewards performance, well, duh. I mean, all you're doing is saying, well, the distribution of wealth matches the distribution of performance. But if it really was, if we had this Pareto distribution where, you're looking at most of the wealth owned by, let's say, this is percent over here, and there's 1%, and here's wealth, and most of the wealth is owned by 1%, you would have extremely low levels of home ownership, and probably depressed property prices everywhere except for certain enclaves of $1 million, 10, 20, $30 million homes. So I don't know that it's wealth inequality that's driving the property price appreciation across all neighborhoods, it seems, and across all home types. So I wouldn't say that it's that. What's your opinion on the low volume of SPY? It is low. Average daily volume in 22 was about 90 million. Week of March 17th saw average volume about 152. Well, the period till today is 79. Yeah, do you think a large majority of, let's see what else it says, of traders moved out of the equity market and back into the bond market? I don't know. I don't think so. Usually, it's rare when we say that they've moved from this to that. A bond portfolio manager is a bond portfolio manager. An equity manager is an equity manager. When they move money around, they're moving from high beta to low beta, from cyclical to defensive, but they're not sending their money over to the bond fund manager. And most retail investors just go from equity to equity. Very rarely do they jump from equity to bonds, from bonds to equities, from equities to bonds. These are allocations that are done at a sponsor level, and even those are only revisited maybe once a year or once every 5 years. So this idea of jumping out of stocks and running into bonds, or jumping out of bonds and running into stocks, I don't think the money really flows that way, because it's hard to explain the positive correlation between equities and bonds for the last almost 12, 13 years. Every now and then it turns negative, but it's still primarily a positive correlation. So no, I don't think it's doing that. I think it is just a matter of the vast majority of money is long only, and you've had a year to reposition. How much more repositioning can you do? If you wanted to move from high beta to low beta, you've done it. If you wanted to move from cyclical to defensive, you've done it. So the market is doing what it's doing, and you're looking at your portfolio saying, well, I'm pretty much optimized. I mean, really, there's not much I need to do. So I think it's the lack of direction and the uncertainty that is causing a lot of hands to leave the keyboard and say, well, look, we're here. We're doing pretty good where we are. Let's just stay here till we get some visibility. We're in quality names. We're in good stocks. We're good enough. I think that's probably more what's going on. Let's see. To show balance sheet reduction, redemption caps are lowered when reserves reach approximately 10% of nominal GDP. What would be the realistic impact of the pause of QT? Ask me in 5 years. Because 10% of nominal GDP is, what, 3 trillion? Balance sheet is at 8 trillion. A runoff of 1 trillion a year. You got 5 years before you get here. I don't even know what kind of environment we're going to have in 5 years. I don't even know what the impact of anything is going to be at that point in time. It's way too soon to even start thinking about what the impact would be for something that probably would never happen, may never happen, and if it does happen at the pace it's happening, is still 5 years away. So I'd leave that one. In your opinion, what would be a hypothetical scenario in which the current market level is justified? Well, earnings would have to increase dramatically, with no one, with aggregate demand holding up. and inflation falling away. And here's the problem with inflation falling away. That means like prices aren't increasing at the same rate. They're still increasing, but not at the same rate. Well, that does affect revenues in a sense, because then revenue growth would have to be lowered from a forecast that maybe you had last year. But everything would have to just work out. It would have to work out perfectly, and the Fed would have to pause and maybe even start cutting rates while everything is great, without waiting for things to fall apart and without signaling a permanently higher cost of capital. They would have to then start cutting rates without a crisis. And that would be, it's such a narrow window with a little bit of pixie dust involved to get you there. That's why I'm still short and will continue to be short. What factors do you believe need to change for a bull market to continue? Well, I've already said that, right? What's the minimum level of option liquidity you require before entering a trade? I don't think I require any real liquidity. You can judge liquidity by volume, or you can judge it by the bid-ask spread. So sometimes you have some options that have a very, a reasonable bid-ask spread. Maybe it's like 8 cents apart between the bid and the ask, but there's no volume going on, but the bid-ask spread is reasonable. It's not unreasonable. Once it starts getting to like 30 cents away, 40 cents away between the bid and the ask, and there's no volume, it's like, okay, well, I'm not going to get anything even if I try for the center of the spread. I'm probably not going to get anything. I've already answered this about where you could find a particular video. I'll pass on that. Could you please share your thoughts on the concept of money on the sidelines? Ugh. All right, Cliff asked his thoughts on it. To find myself a bit confused about how to think about moving money from equity to bonds. Well, it doesn't really, it's not that common. It's when you think about it, I've never moved money from equity, saying, I got to get out of equities, let me get into bonds. I got to get out of bonds, let me get into equities. I've never done that, jump around like that. Usually you have a preferred market that you trade in, and you just trade within that preferred market. There's always a trade in the markets you're in. But money on the sidelines, I've been hearing this ever since I've been involved. I don't know that there's ever been a time where I haven't heard somebody say there's a lot of money on the sidelines when they're trying to justify why the market goes higher. There's a lot of money on the sidelines. There's a lot. Yeah. Guess what? A lot of money lives there. It's not that it's on the sidelines. That's its home. It lives in money market funds. It's not on the sidelines. Not all cash is cash waiting to head into the market. There's a lot of cash in marketable securities from corporations that just sit in marketable securities, and they have no interest in jumping into the bond market and no interest in jumping into the equity market. Their home is money markets. That's where they live. Period. So this idea of there's a lot of money on the sidelines, I've never bought into that. Yeah, there's always a lot of money on the sidelines though, right? Every time someone says there's a lot of cash on the sidelines, a tiny part of my soul dies. There are no sidelines. Those saying this seem to envision a seller of stocks moving her money to cash and awaiting a chance to return. But they always ignore that this seller sold to someone who presumably moved a precisely total amount of cash off the sidelines. Exactly. I can't argue with that. That's why I like this guy. If you go on YouTube and type in his name, listen to some of the stuff he says. He's out there a lot. He's just right down the middle, common sense stuff. You know what I mean? Like, he doesn't get wrapped up in all of this hype about, well, this signal and that signal with this and that. And when I first heard him speak, I thought, well, there's a breath of fresh air. There's somebody with some common sense I can listen to. And that is a perfect common sense statement, because whenever everyone says there's a lot of money on the sidelines, it's just one big internal eye roll. It's like, oh, come on, man. I mean, it's just like a real estate agent who says it's never been a better time to be a buyer. No matter what's going on in the market, never been a better time to be a buyer. There's a lot of money on the sidelines. Just tired statements that tell me that you're out of ideas. That you're out of ideas. You said in your last Q&A that you'll show us how to buy treasury in IBKR in this market outlook. Is that something you still plan on doing? I have explained how to do it. On the main screen, at the very top, you got a bunch of icons. One of them should be a treasury icon. If it's not, look all the way to the end. You'll see a little arrow down. You click that arrow down, a menu opens up and it says treasuries. Click on that, a window opens up, and pick your treasury. Pick which one you want. You could pick, one that's expiring tomorrow, in 3 days, in 5 days, in 8 days, in 9 days. You can click on 2023, 2024, 2025, 2026. It'll give you all the bonds that are expiring at that time. If you want to participate in a treasury auction, then Google Treasury Direct. Your broker, depending on who you have, may allow you to may have Treasury Direct that you can use right through your broker, and you can actually just participate in the next auction, in the next Treasury auction, and get an on-the-run bond. So there's it's easy to do. I'm an active trader in Forex markets. CFA helps me with understanding the economics data. My question is, where do I find data like rate cut pricing for just CAD or odd? Do the CME has like watch tool for other currencies? I don't know what you're asking me. Rate cut pricing. These are, maybe this is a vocabulary and a series of words that mean something when you say it. But to me, it, maybe I have different words in my vocabulary that mean what you're trying to say, and those words don't look like the words I have, so I don't know what you're referring to. Rate cut pricing. Do you mean like Fed funds futures? And what the market is pricing in? If you mean something like that, I think each exchange would be different. It would depend on the short-term interest rate securities in each particular market, if that's what you mean. With respect to futures, could you explain the continuous expiration one? I did that. That is so that, if you have June futures, it'll show lists on the chart. That if you go back too far, there's no volume and then it ends. And then you go to September, and then by the time you turn September on, it has very light volume. And then as time goes on, it starts to get volume. Well, the continuous gives you, the futures price over multiple years, as opposed to September. If you look at the September futures contract, there was no volume last year, so it looks like there was no price action. That's all continuous is going to give you. What is your preferred moving average? If I do use them, they're simple moving averages. Why? Because that's what everyone uses. And not that I believe them, but I know a lot of people believe them. And if I'm going to use a moving average, I want to use what everyone else is believing, so I see what they see. I thought implied volatility relates to the price movement of options whose price is calculated by Black-Scholes. Yep. The inputs for Black-Scholes do not include volume. Nope. But a lack of volume will change the price. Way too much volume will change the price. And since the only thing that can change is the implied volatility, because everything else is observable, anything that affects the price will affect implied volatility. Let's say I have an option on futures. Is there a way in IB to show the underlying price in the graph? On the options on the futures, I don't know. I think so. Actually, I don't know. I don't think I've ever tried to look at a graph of one before. I don't know. Good question. Canadian currency moves mainly with oil and risk sentiment. Positive risk sentiment and higher oil is good for CAD. And the opposite is also true. I deal with this currency pair at work often. That's how it's been trading for the past year or so. But yeah, odd currency. Yeah. Do you have any insight into how dealers, market makers, hedge their positions over time? Why would it be different over time? I don't get that. I've been listening to a few interviews by Ken Carson. He's interesting. Basically explaining that market makers are mostly short puts and long calls. While institutions are long puts and short calls. Yeah, I can see that. Market makers are mostly short puts. I can see that. They're long calls. On the index, maybe, but on individual stocks, I don't know if I don't know. I guess if he says if that's what he's seeing, because I believe they're a market maker as well. Over time, as the market maker's delta changes, this leads to volatility dampening as they have to buy back some of their short stock that offset their short puts. Likely not the factor. Okay, I see what you're. Yeah. Well, yeah. If you're delta hedging, you have to do the opposite of what you've done. So that if somebody buys a call, you got to sell them a call, and if you sell them a call, you got negative delta. And over the course of the day, it really depends on the imbalance at the end of the day. And it depends on the imbalance that the market creates. The market's usually fairly balanced. So what happens is you're a dealer, and so you offer a bid and an offer. So people will buy from you on the offer and will sell to you on the bid, and you make this spread. And you have volume on both sides all day long. So at any given time, you have positive delta, you may have negative delta, then positive delta. Then at the end of the day, you're going to have some net delta exposure, of which you're going to hedge out with the underlying. So if you have negative delta, you have to buy the underlying. If you have positive delta, you'll short the underlying, so that you have a neutral book at the end of the day. And you just close it out at the end of the day. At least that's what you're hoping. But if there is an imbalance in the market where everybody's buying calls on something, you'll build up an imbalance where you then have to start buying so many shares because you have so much short delta on the calls that it'll end up starting to push up the price. And this is sort of what happened with all the meme stocks with Wall Street Bets, is everyone started buying calls, which forced the dealer to buy the underlying, which pushed up the value of the calls, which forced even more call buying, which forced even more share buying by the dealer. And since the price was going up, their deltas were getting more negative, causing them to buy more shares. So gamma was starting to affect them as well. And you had this squeeze on the way up. In an individual name, you might be able to get that done, but at the level of an index, it would be rare for that to happen, because usually you'd have a balanced book. And if you're a market maker and you become imbalanced, you tend to widen your bid and offer, so that if there's another market maker on the stock, you let them step in while you try to find some balance in your book, because you don't want to get too imbalanced with too much negative or too much positive delta. But I'm not a market maker. This guy is, the Ken Carson. So, if he says that that's going on, then you sort of just got to take him at his word that he's got far more access to far better data than I do, and he sees it going on. So, the market making function could be causing some effect on volatility. I'm going to go ahead and say yeah, but I couldn't tell you in what markets it's doing it and what markets it's not, other than just what I just explained. But I don't get into the Vanna and Charm stuff, like the derivatives of the derivatives. A change in delta for a change in something, a change in gamma for a change in something, a change in vega for a change. I don't get involved in that kind of stuff. It's just too small for me to even consider. How do you know how much position limits are for utilizing reverse repo? New York Fed. Can you please explain what is the rationale thesis behind MREITs? And how does it compare versus, well, a mortgage REIT only holds mortgage-backed securities. Home builders build houses. They are two different companies altogether. Let's see. I'm a little mixed on understanding valuation of stock. Okay, well, that was just a statement. IYR trade. I mentioned that I'm for IYR. I have a January 2024 $80 synthetic short, of which I got I think $1.15 more than where the price was when I did it. So I could have shorted IYR or did the $80 synthetic and give me a short price that's actually like $1.15 higher than where IYR was when I put it on. How do you tactically move in and out of an inverted straddle or strangle? Well, I can only imagine that you got into that from a straddle, that you didn't actually create an inverted straddle to begin with. And just so that everybody understands, let's say we have a stock at $80. You can, if you are short the straddle, you sell the call and you sell the put at the same price. That is a straddle. Inverted would be that you'd put your put above your call. So let's just say that you started with a straddle and the stock price moves up. Your call is losing money, but your put is making money. You tend to roll your put up to rebalance your delta back to zero, because this has a zero delta. So as the underlying moves up, you keep rolling up your puts. And then if the stock comes back down, well, guess what? You now have an inverted straddle as the stock is coming back down. If you rolled up as this is coming down, you let it come down because the premium is coming out of your call. And as the premium is coming out of your call, you roll down your call. You always try to remember where you started and rebalance to that. So it doesn't matter what kind of crazy strategy you have going on. If your delta when you first start is zero, and after a couple of days you have a different delta, you find a way to rebalance back to zero, whatever it happens to be. Whether it's through the use of another call, or put, whether it's rolling one of them, or whether it's buying or selling some portion of the underlying. If you get uncomfortable with what's going on, you want to rebalance back to where you started, back to a delta of zero. Is now time to add some duration in Canadian bond portfolios. I know nothing about Canada. Even though I'm Canadian, I live in Canada and I pay Canadian taxes. Well, I pay Canadian taxes and then the government confiscates the rest from me. So I pay 40% tax and the government confiscates another 13%, state-sanctioned confiscation. So beyond that, I know nothing about Canada or the Canadian market. I couldn't even tell you where the Canadian 10-year is. Not a clue. What makes you think ChargePoint is attractive? I don't think I ever said ChargePoint is attractive. I don't think it's attractive. I can't get out this. I don't know what that means. XYLD. I live in Canada. Came across a U.S. covered ETF, which tracks us. Oh, I answered that in the live session. I'll pass on that one. And do you think the de-dollarization of oil combined with the fact that China buys a lot of gold will make U.S. dollar falls? When do you think it'll happen? No, I don't. No, I don't think it's going to do anything to the U.S. dollar at all. Nothing at all. Let's see. Why are most experts so concerned with how high rates go and not as much about how long the rates will remain elevated? Yeah, that's curious. It seems like everyone kind of thinks that the Fed is going to raise rates, and as soon as they hit the target, they'll say, "Good, we got it. We hit our target. Let's go back down." That's not the way it works. You don't drive all the way out to the West Coast, touch the ocean, get back on your car, and head back to New York. I mean, you hang out there for a while, right? So I think that slowly they're going to have to get used to the fact that, hey, hang on a second, the cost of capital is not coming back down, is it? But the market, just is so short-sighted when it comes to risk. It's, there's hope. They're going to cut rates. Not until the Fed does not cut rates for an extended period of time will they say, oh, I thought they would have cut by now. So there's 2 cuts priced in by December. We will have to actually wait to December for the market to say, oh, they're not going to cut because it's already December and it hasn't happened. They won't anticipate that it won't happen. It actually has to happen. Or no rate cuts actually have to not happen. I think I got 2 double negatives in there, but you know what I'm saying. If monetary policy hasn't shown to do much to reduce aggregate demand, would fiscal policy work more? Well, you're asking your elected officials to do something. Come on, that's not going to happen. Increasing taxes to corporations and households while governments restrain spending. Okay, we can stop right there. Who thinks that governments are going to restrain spending anywhere? The Canadian Liberal government in partnership with the NDP, is going to stop spending or cut back on spending. Who thinks that's going to happen in any world? The Democratic Party in the U.S., who thinks anywhere that they're going to cut back on spending? Who? we know that if they could, they'd increase the spending as much as they can. So no, this is not going to happen. And increasing taxes on households, they're not going to do that. They'll only increase taxes on successful people. So no. When you're looking to the fiscal to do the smart stuff, that was over 20-25 years ago. Smart government is long gone. We're in the era of clownmanship, and it's as clownish as you can be, then you can get elected. So don't even look to your elected officials to do anything intelligent at all. How's the chipmunk doing? Still eating off your hand? I haven't seen the chipmunk since winter's been over. I saw it once out front, sitting on my truck, on the hood of my truck, and then it just sort of ran into the engine, and I haven't seen it since. But it will, as soon as I see it. And that's it.